Our next speaker is Mr. Sheetal Soni. He's partner MI Capital. Please welcome him.
Hi, good afternoon, everybody. Is my voice clear? Thank you very much. So first and foremost, I would like to thank ICAI Abu Dhabi chapter as well as Khalij Times for giving me this opportunity to speak on topic called revaluations. And I'm really thankful, in fact, for the reason that so far most of the speakers have spoken about how you will be taxed. I'll be speaking more about how you will save tax. So thank you again for the ICAI Abu Dhabi chapter for this particular topic to me. So before I get into the details of the topic, I would like to ask a question. How many of you are happy that corporate tax is coming in UAE? Please raise voice, please raise hands or voice, whatever. I want to hear the voice from the audience. I think everybody is happy, no? Everyone is chartered accountant, more opportunity, more, I would say, more relevance in the market. In fact, how many of you are super happy that the corporate tax is coming? Consultants in the room, please. I think consultants are very happy as well. So, okay, I want some raising of hands as well, if you don't mind. How many of you are in UAE for more than 10 years? Quite a lot of people. I can understand the struggle that you are having. It took me a few years to unlearn the taxation when I came to UAE, and it's taking me more time to learn it again back. So I can understand the pain. How many of you are here for 20 years? So I can see, I mean, you must be feeling it very stressful now. So moving on to my topic, I want to first start with a question. Almost everyone is chartered accountant. So please tell me the assets in the balance sheet. Please throw the names of the assets in the balance sheet, please. From the audience. Property, plant and equipment, very good. In fact, most important asset, that's what consumes the most of the weight of the balance sheet. What else? Investments. Investment is an asset. What else? Cash, most important, fuel. What else? Receivables, excellent. What else? Inventory. So you don't consider intangible as assets, eh? You are all prudent chartered accountants. What about intangibles? Can you give me some examples of intangibles in your balance sheet? IP, copyright. What else? Trademarks, excellent. Goodwill, yeah, goodwill, yes, true. What else? What all assets? Cars, plant and machinery, we mentioned about plant and machinery, cranes. What about financial assets? Financial assets in the balance sheet. Everybody is chartered accountant here, please. Receivables, yes. Investments, securities, financial liabilities. Can you share some examples of financial liabilities in the balance sheet? Loans, excellent. So that was my way of checking if you are listening to us or not. And so far many people have been here. I was not sure whether the audience are engaged or not. So the topic today is about revaluations of assets. I mean, so first and foremost, you have to understand, the law does not require you to revalue the assets in your balance sheet. Your closing balance sheet will be your opening balance sheet for the first tax period that you enter into. Except few changes that they may suggest, so far they have not. And the second thing, that you cannot do any financial engineering to make your opening balance sheet or the closing balance sheet before you enter your first tax period to make it look, to save taxes or whatever. So the GAR provisions do apply as well. So they have the law, the ministerial decision 120 talked about the categories of assets who will get the benefit of revaluation. So why do you think that this particular revaluation topic is there at all in corporate tax? What is the reason? Can anybody share his thoughts on this as well? Why do you need to revalue the asset? Yeah, please. Good point, but hold your thought. Any other reason? So that it reflects the market value. So you get more benefit of depreciation. What else? Sorry? Reduce? Reduce gain on disposal of the assets. Correct. Any other point? Increase? Increase the value of the business. Okay. To give shareholders? Sorry, I didn't get this. Sorry, can you speak again? To showcase the correct value of the assets. Okay. So to comply with IFRS. Excellent. I think great ideas in the room. Clap for yourself. So in fact, yes, all of these are correct, but particularly from corporate tax point of view, one of the point that was made was to get the benefit of depreciation. That is unfortunately not the case for corporate tax perspective. And we'll cover in the session why it is not the case. To reflect the fair value of the business is also not the intention of the tax authorities. What the tax authorities want is in fact giving you the benefit of the value of assets. If suppose you purchased a land in 2015 and the value of the land has increased by 2023, you don't want to get taxed on that land when you sell, let's say for example in 2024. So to get you one of the answer from here was to reduce the gain on sale of assets when these assets will be sold. So that is the main purpose and the main reason that this particular provision is there. So effectively, it's a good provision that helps the business to optimize their tax liabilities and not to be taxed for periods of gains for which belongs to tax-free period, which is prior to the corporate tax law coming into effect. So they have came up with three major categories of assets who will get this particular benefit. The first category of assets is immovable properties. I think from our first interactive session, for interactive question, property, plant and equipment is an immovable property. Land is an immovable property. What else is immovable property? Building, very good. Building is an immovable property. What else? Yeah, real estate. Yeah, these are the categories of properties which are immovable properties. Now the second category is intangible assets. We discussed about intangible assets, the copyright, the patent, IPs, these kind of things. And there is something called financial assets and liabilities. We also discussed about it. We'll get into the details of it during the course of this presentation, but do you see anything missing in this which you would have hoped for? Other tangible assets. What else? How about movable properties? Movable properties is missing in this. So you don't get the benefit of movable properties. Cars, cranes which is movable. Inventory, excellent. What else? I think these are broadly the example. There could be other things, which is paintings, correct? Which could be furnitures, so which are traditionally valued at cost or depreciated value, but they don't get the benefit of revaluation. So you get the benefit of revaluation only in these three major categories of assets. So let us see what are these three, how are they defined in the corporate tax law. The Ministerial Decision 120 talks about immovable property, and they have given the definition of immovable property. And the definition says any area of land over which rights or interests or services can be created. So land, we discussed about it. Then any building, structure, or engineering work attached to the land. So anything like any engineering work, building which is attached to a land is also covered in it. Can you tell me, is leasehold improvements on a building will be part of this? From the definition, it is very clear that it will be part of it. It doesn't matter that you have to have a freehold rights on it. The third point is any fixture or equipment which is permanently attached to building, structure, or engineering work. So any plant, machinery, any furniture or equipment which is attached to the land on a permanent basis. This is also considered as an immovable property. Can you tell me a crane which is on a port? Anybody from port industry here? Anyone from port industry? Nobody. So the example is if a crane which is attached to the land work, then it will be considered. But if a crane which is movable in the port, it may not be covered. So similarly, anybody from contracting industry? So the cranes that you use in the contracting industry for building works, it's mostly movable. So it may not, from the definition, it looks like it will not be covered in it. Then they talk about intangible asset. The definition of intangible assets according to the ministerial decision is, they have given it to the vice accountants. So they have said it is as per the IFRS. The intangible assets is defined according to IFRS. IFRS says an intangible assets is an identified non-monetary asset without physical substance. So we all know about it. Such an asset is identified when it is separable or when it arises from contractual or other legal rights. So this is, and separable assets can be sold, transferred, licensed, etc. I'm sure a lot of IFRS expert, I am not an IFRS expert to caveat, but this is the definition of intangible assets in the IFRS. And also, financial assets and liabilities, they have kept it to the vice accountants and the IFRS definition, which is equity instrument, debt instrument, and derivatives. So basically, before I get into that, can you tell me from the IFRS experts I am asking in the room, can you give me some examples of assets which are valued at cost in the balance sheet? Inventory is valued at cost. Excellent. Any of these within these three categories? Inventory, we discussed that it is not unfortunately covered. Machineries, excellent. What else? IP rights, excellent. Yes. Although IFRS, I learned that IFRS 9 has, IFRS 38 has largely required nowadays to fair value most of the intangibles as well. But tell me, what else? Buildings, superb. What else? In financial assets, anything? Held to maturity, correct. Any of the assets who are held to maturity. So what are any examples of balance sheet items within these three categories which are required to be fair valued? What? Investments, perfect. Investment properties. What else? So effectively, if you see, they are of no use as far as we are concerned, right? If it is being fair valued, then you don't get the benefit of the new valuation which exists today, right? Before you enter into a tax period. So what matters, what needs to be considered is those assets which are valued at cost or written down value. So amongst all the assets that you see within these three categories which are valued either at cost or at written down value, amortized cost, right? This particular ministerial decision 120 is applicable on those assets, and you can claim the benefit of revaluing those assets, and I'll cover it is not revaluing as it sounds, no benefit of depreciation, which probably you have seen, one of the point which was made. So we'll talk to the first asset, which is immovable property. The decision says it is that particular immovable property. They have said, you know, like in free zones, you might have heard the term called qualified free zone, right? And qualified incomes. Here also they have used qualified investment properties. What is qualified immovable properties? Sorry. So what is qualified immovable properties is 3 conditions. One is owned prior to first tax period. So you should be owning it now, right, before you enter into the corporate tax period. The second, it is measured on historical cost basis in financial statement. We discussed about the cost element of it. And the third point is disposed or deemed to be disposed on or after the first tax period for value exceeding the net book value. So it should be deemed to be disposed exceeding the net book value. Then only you can claim the benefit of it. They have given 2 options to it. 2 options to us to choose. The option 1 is either you can identify the value of these assets, reduce from it the book value or the written down value, whichever is higher, and that particular part of the income you can claim, you can identify, and not to pay tax upon sale of these assets in the future years. So I hope I am clear. If I am not clear, please raise hands and I can repeat myself. We are getting into complex calculations now. The second option which you have, if you don't want to get into the identifying the fair value today, then whenever you sell the asset, suppose you sell the asset in 2026, then you identify the same difference, how much you sold it for minus the book value or the written down value, and divide it by number of days which you held prior to the tax coming into UAE. Multiply it by the number of days which prior to the tax coming into UAE, divide by the total number of days that you held the asset for. So effectively you are getting the pro rata benefit of the value of the gain that you get from such assets. Clear, right? So option 1 is fair valuing it today. Option 2 is not to fair value, but whenever you sell it, you can identify, you can pro rata allocate the gains between the pre-tax period vis-a-vis post-tax period. There are a few other conditions as well. Other conditions are adjustment to taxable income subject to election made by a taxable person. It is not automatic right that you get. You have to elect in your first tax period that I am going to take the benefit of it. So it is very important point. When you file your first tax return period, you need to identify by each asset, and this is the second point, election to be made for each QIP upon submission of first tax return and deemed irrevocable unless exceptional cases. So for every single asset that you want to qualify as, call it as qualifying immovable property QIP, you have to identify and for each such asset, and then you have to make an election for it, whether option 1 or option 2. Market value to be determined by relevant government authority. So this is something which still needs clarification. They have used this wording called market value to be determined by relevant government authority. They have not come up yet with who will be the authorized parties who can potentially value these assets. So we are hoping that that typical valuers, registered valuers would be able to do that. But this particular clarification has not yet came. So these are the major conditions as far as immovable properties is concerned. To be able to qualifying immovable properties and to gain, you have 2 options to deal with it. Moving on to an example, if suppose a cost of asset is 100 million, which you have acquired in previous years, say 2020, sales value of this is 200 million, which is 2026, for example. Market value that you have identified is say 150 million, and written down value, because it's being depreciated, is 80 million. You depreciated it by 20 million. So number of days which the asset is held prior to the sale period is, we have calculated 1460, and number of days, total days is 2,555. So according to the option 1, what would be the answer? So the current market value is 150 minus 100, not 80. Huh? So you see the difference? It is higher of book value or written down value. So they don't give you the benefit of depreciation which you have claimed during the tax-free period. So you get a benefit of 50 million. Whenever you sell the asset, this 50 million will not be taxed. But you have to choose for it. You have to opt for it during your first tax period. And in option 2, it is 57% of the time period which you held the asset before sale, you get the benefit of this. So effectively, this 100 million is 57 million, you get the benefit of it. So far, I hope it is clear. Please feel free to raise your hand or ask any question on that. Please go ahead. Very good question. Very good question. In fact, this revaluation is not in your balance sheet. This revaluation is not there. The tax authorities are not asking you to revalue these assets on your balance sheet. In fact, if we go to our first slide, your opening balance sheet will be your closing balance sheet, and you don't need to do any changes in your balance sheet for this. You don't play with IFRS for it. IFRS wants you to value at cost, you value at cost. But in your tax return, you will get the benefit of this option 1 or option 2. So effectively your tax, it is only for the purpose of your tax returns. No, you have no option, not might or whatever. It is, you have to continue with your accepted principles. You cannot change it. You will be under GAR rule if you do that. GAR prevents to do that as well. Any other point? Please, yeah. If you make a loss on an asset, it is only for gains. This is the third condition. Disposed or deemed to be disposed during or after first tax period for value exceeding the net book value. So you cannot claim the loss of an asset, right, in your future tax period when you will have probably a taxable income on it. So it is only giving you the benefit of getting a benefit of not being taxed on income which relates to the period on which the no corporate tax was not applicable. Any other point? Okay. Now we talk about the second category of asset, which is intangibles. Again, the same thing, qualifying intangible assets, QIA, qualifying intangible assets. 3 major conditions. First is owned prior to first tax period. So owned prior to first tax period. Second is measured on historical cost basis in financial statement, similar. And the third is disposed or deemed to be disposed during or after the first tax period for value exceeding the net book value, which is the profits. So similar 3 conditions. However, the catch is only one option. In immovable properties, we have seen there were 2 options. Here, there is only one option, wherein for intangibles, they are not. The law does not allow, the ministerial decision does not allow you to fair value those today and calculate between the 2 options which works best for you. Here, whenever you monetize, whenever you sell the intangible asset, you get the pro rata benefit, the number of days calculation that we did. And the last bit is about financial assets and liabilities. In fact, you should also note that they have also covered liabilities as well. So financial assets and liabilities. 2 major conditions: owned prior to first tax period, and the second is measured on historical cost basis in financial statements. In this, again, not 2 options, but you cannot opt for the pro rata. Here you have to fair value. And and take the benefit. You don't get the benefit of pro rata. You have to take it, you have to fair value them today, and you have to get the benefit of it. So no two options, but in fact option 2 of immovable properties is applicable on it. Is this clear? Again, the other conditions remain same, which is adjustment to taxable income subject to election made. You have to make that election to be made for QFA or QFL upon submission of the first tax return. In your first tax return, you have to make that election for every single asset, and you can make different elections in immovable properties. Here you don't have two options, so you can only make one election. So this was all about what I wanted to present. Just to summarize 5-6 key takeaways. One is apply to certain assets measured on historical cost basis. It is only for those assets which are measured on cost basis. No benefit to assets which are on fair valued. It is to avoid paying taxes on gains attributable to pre-corporate tax period, not the losses, only for the gains. Financial statement not need to be reinstated for those assets or classes. One of the point, we don't need to change the financial statements at all. It is only for the tax return filing purpose. No increased depreciation or capital allowance if elected. So one of the point which was based was if the depreciation will be increased. It is not the case. You will not get the benefit of increased depreciation because you are not changing the value of the assets in your balance sheet. Election to be made voluntarily at the filing of the first tax return. If you forget to take the election, you lose the benefit. And aim to ensure fair and accurate representation of gains and losses. So this was all about revaluation of assets and gains. And thank you very much for this opportunity yet again. And if there is any further questions, happy to take here or during the networking session.